Welcome to the Advisoryn podcast. Today we are joined by Randor Falconer, a venture scout and angel investor who helps FinTech founders secure capital. Randor, great to have you.
Lovely to be here. Thanks, Daniiar.
Randor, you connect founders with investors. What led you to this role and what's your background?
Yeah, definitely. So my background is corporate advisory. I actually went and worked for a few startups as well in between. And then, yeah, went into corporate advisory and usually dealt with late stage investors and companies. So pre-IPO, we did some on-market placements and so forth. But yeah, I just had because I came from some startups as well prior to corporate advisory, then afterwards I dived back into it. I had this just natural blend towards early stage. And then I was like, well, obviously I like the investment side and how can I blend the two together? And then as well personally, yeah, my personal structure and how I wanted to operate was like more autonomous, hence me going out on my own. And yeah, now I connect founders to investors.
That's great. So you're like a freelancer in connecting investors with
Yeah,
startups.
yeah, definitely, Daniel. So I'll probably say it is a like independently contracted, I call it. But yeah, pretty much. Um, I run my own game, and I connect, yeah, founders and investors, and there's different partnership agreements between the two. So
That's great. Let's talk about funding challenges. What are the absolute red flags that makes investors pass on a fintech startup even with like really strong tech?
yeah, interesting one. Well, I think obviously defensibility, so strong tech, like you said, having strong IP. There's a lot of these no code platforms out at the moment. So the entry level is super easy. So you know, we like to see complex solutions and IP because the entry level has got some sort of barrier, high competition essentially. Another thing as well, having like strong, especially in the fintech industry, the KYC, AML setups. So making sure everything's fully structured, there's no caveats. So really doing the due diligence properly is super keen, super necessary, should I say? So
What do you think by percentage of importance? How much percentage goes for your strong pitch deck and sales skills,
yeah.
and for how much goes for really the tech?
So do you mind repeating that again?
By So in terms of percentage of importance, different parts, how much percentage goes for strong tech and how much percentage goes for strong pitch deck and really good sales skills and really good evaluation and business part?
Yeah, it's really a full 360. Tech IP is super important today, but then obviously business model and go to market. Another thing is obviously the founding team, super important. The background and skills, you want to give clarity to investors, right? So you need a lot of them will see or not invest due to team diversification of experience, education, these sorts of things. But as a whole, I would say it's a full 360.
Mm.
Initially, the pitch deck needs to look user friendly and good and clear and concise for initial engagement. But yeah, having the conversation skills also helps as well. And then once investors do due diligence, that's when you got to have your metrics and numbers and operations set up and that sort of thing.
Which numbers startup should already have to even start searching for an investor and come to you? So let's say I'm in a startup and I come to you and I say like I need an investor. Which criteria you have to validate me?
Yeah, so a few criterias, as in for me doing a due diligence on you, so doing the vetting process for a founder, how would I see the founder and whether I want to refer them or not? Is that what you're saying?
Yes.
Okay, sure. So Between my referral partners, which is my go-to, first I'd look at the mandates and sector focus, and I'd fit and align the right, business model to the sector focus. Then a few things I'd look at is just obviously metrics, current, so from company setup to now, the growth rate, and then metrics around financial snapshot, CAC, a few other things as well, and really just see that initial financial snapshot after viewing the tech, because people can go on and on and on, but you need to see the data, right? That's key.
Mhm. Which financials you should have to start looking for investors? So in
Yeah,
terms of example, for a fintech startup.
yeah. For fintech startup, well, really just numbers. So high retain any business really, just like you want to see, especially if you're doing pilots, depends if you're pre-revenue or post-revenue, but you want to see solidified partnerships or businesses or customers, whether it's B2B or B2C. You want to show user case on high retention rate for either customers or feedback around that. If it's pre-revenue, just strong feedback really comes down to the more traction you have in different measures. But yeah, I would say um, you would need higher retention rate, the cost of acquisition of customers super important, and then your essentially what a forecast of P&L looks like and your margins essentially. So you want to make sure that you have healthy margins, low operating costs, especially with the competition in fintech. So yeah, there's a few caveats around the metrics there. Do your due diligence about essentially.
How can fintech founders move beyond generic lists to identify and target like the right investors?
Yeah, a few ways of doing this would be initially just going and actually doing a deep dive into your investment preference, for example. So whether that's venture capital, it might be a crowdfund model, it could be an angel, a family office. So diving into that and then really coming down to what are the benefits, what are the off takes, and seeing the thesis and the mandate around these investment firms. And, if you're in fintech, making sure that you've got an investment partner that focuses on fintech, ideally a major focus of fintech. And then with that, you want to make sure that you can correlate between existing portfolio companies. So for a new fintech pitching, they want to be like, hey, you've got X in your portfolio, or you've done a recent investment into X. We do this, but it's similar, or there's you can correlate between an investment already. It's like essentially it's future proofing. So I think founders don't do this enough. And so showing early conviction, this is one of the signs to do so.
Mm, okay. So it's really, really important to find the right investors, not like investors in general, but the right one who already invested at similar products, and this will increase the chance that this investor will go in with you.
Yeah, definitely. The whole spread and pray and whatever. If you're good at your tech, you can essentially get traction. But realistically, to be more tailored and the long term, I think benefit of each party would be just, aligning the right capital. So making sure that, you're really doing research on the investment partner you're looking to bring in. Because what that could mean is that you have a better relationship moving forward, whether that's introductions to new revenue, whether that's partnership introductions or other investment firms slash advisors that you can take advantage of having the right partners. And so it also comes down to what investment firms you want to take as well, and what's going to give you the best return on your time and your product, right? So that's something for them to figure out.
Okay, so you just told me that it depends on what investments firms you can take, and what are the differences? Are there any big groups of investors who does the deals differently? If yes, you can tell the differences between them.
Yeah, as in the different investment partners, like venture capital to crowdfund model, or something like that, or.
Yes, like key differences.
Key differences. Yeah, yeah, definitely. Well, crowdfund is really a platform for multiple investors to get into deals through a one trustee, usually like a syndicate. So it minimizes cap table distraction, and negotiations are usually handled on platform compared to between investment partner and founder. So it's more of an efficient way to capital raise for the right startup, I guess. Another obviously venture capital is that they usually have funds they're looking to get high returns. Therefore, due diligence is a lot more severe compared to a crowdfund model. And essentially, the investment partners have to perform for their LPs, right? So they pick wisely. Sometimes due diligence can take longer, usually longer. And so that's that. Yeah, there's a higher vetting process with venture compared to crowdfunds generally.
Mm,
Yeah. And then you've got angels and family office, which can be a bit more lenient, but usually take more of a preferential focus on personal interests and so forth. So
mm,
family office might be more values driven compared to super severe metrics and foreseeables. And that's the same with angel investors.
okay. So, in short words, if you need money, if you need fast funding, then you go to crowdfunding way. If you can wait for long enough and you have good product, you go to venture capital because they are looking for high returns. And if you know someone from angel investors or family office, then if you know someone and you know that they are interested in that, then you go by this way.
I always say, look, if you can bootstrap to the point where you cannot, and you can create evidence and traction data throughout that bootstrap period, then aligning the right capital. I think it's really important to take small steps to make sure you're getting the right partners. But yeah, you're correct. That is correct. Crowdfund's usually a faster way to get capital, but preferential. There's difference. I would obviously usually go family and friends first, small equity pieces, potentially depending on what angel investor, then from there seeing the foreseeables whether crowd funds make sense or venture capital. Yeah, it's product and it depends on what we're dealing with startup. So
Yeah, and during our conversation, I heard the interesting advice. So, can you please align on importance of finding the right investor, not just like funding in general, but
yeah,
like the right people who can fund your business, and how key is this metric can be for a startup? For example, you are doing the fintech startup in like B2B, and if you look funding in venture capital firms or crowdfundings that are never done investment to such kind of a startup, then how your chances of getting funding will increase or decrease depending who you are talking to. So how diverse it can be.
yeah, look, I think time and effort, right, comes down to time and effort of an individual. What happens is operating costs keep rolling on as the business is live. So yeah, really making sure that time and effort is placed in a correlated way. Obviously, I'd say come to me for help if you don't know where to look. But I think leveraging connections and relationships as well is super important. So tapping into to people you know that can actually do introductions for you, really, really important. It takes sort of the time off to establish those relationships yourself. So yeah, these are a couple of points that I'd recommend.
Okay, so the pitch deck and introductions opens the door. And what non-metric factors must founder prove after the pitch to secure a funding?
Yeah. So if it's messy, are you saying?
Can you repeat, please?
So do you mind repeating that one again? Sorry.
Okay. What non-metric factors must founder prove after the pitch to secure a funding?
Yeah, sure. I think having good sales skills or good potential foreseeable sales skills. So able to communicate in a concise manner is super important for investors. They know you're able to either lead, you've got confidence, or you can sell essentially. So I think being able to present is super important without the metrics part. Making sure actually presentations are easy to read and show easy correlation and linear between what you're doing now, what you need, and where you're going to be, and making sure that you're presenting that to someone as easy as possible. So making sure the deck is really nice and clear um, is key as well. Um, so
Mhm. Okay. And your role as venture scout is quite unique. It's really first time I'm seeing someone in that position. How was function of venture scout evolved, and what critical role do you play in connecting founders with capital and deal now? So what exactly you do?
yeah, how the venture scout role kind of has evolved. Really, people can call it venture scout. They can call it they like investment analyst, right? Like of a VC firm. A scout really, there's two ways. You're an external scout, I guess, like myself, or your internal scout. And usually, internal scouts will have names on bigger firms, bigger VC firms that might be global. But essentially, I think how it's evolved is really open doors through referral networks and scouting capability with the internet and the possibilities through social platforms like LinkedIn and other on market platforms like VC networks. I could name a few, like Open VC, and so scouts to have the capability, whether that's referring into or internally. And I think as a VC scout, there's compensation rewards as well, either internally and externally, just like a referral partner, right? So whether that's a carry or a one-off payment, and so um, it's getting more competitive, the venture scout role, but I think it comes down to how good are you at finding top founders, essentially top startups. How good are you at doing your lead generation? How good are you at communicating? And this is something that sort of needs to be developed and I guess learnt throughout the process, which is kind of what I'm doing and have done as well.
In terms of your role, so what exactly you do? So you found
Yeah.
some startups that needs funding. Let's say you validate them and they're good. And
Mm.
what next steps?
Yeah. So once go to my existing referral network, for example, the investment firms I'm across, I'll align the two synergies. So I'll create synergy between the two. So aligning the right capital, making sure that I can really compile the founder and investor, and making sure that I can do the right introduction. So how it works is I essentially find the founder startup through a variety of different ways, and then they will fill a form out for me. From that, I can run through a due diligence around metrics, data, and then also where to position in terms of preferential investor profile and so forth. And then I would create a shortlist from that document to see, okay, does X partner fit with this founder? you know, are they pre-revenue, post-revenue? What's the preference around the investment profile, and making sure that aligns. So essentially, yeah, that shortlist is really important for me to really do the introductions, and that means I can get really good engagement from those investment partners, which can help the founders in quicker timeframes to meet these investment partners, but then potentially a better possibility of investing, because I'm doing the correlation and obviously submitting the founder into what the investor is looking for, right? So a lot of founders might just go on and on and on, but really just keeping it nice, clear, and concise is super important. Because these VC firms get hundreds a week, you know, so sometimes more, sometimes a little bit less, but you know what I mean. So really showing clarity between representing you as a startup and what that is. You just need to be clear because there's a lot of distraction with decks and yeah everything around the startup ecosystem. So showing conviction is super important.
Mm, okay. Um, what's like in your opinion the top three mistakes that founder makes during the fundraising?
Yeah. So actually, one's probably maybe obvious, but pitching too early. So a lot of founders will essentially pitch before getting enough traction. If you are a founder and you put yourself in an investment profile position, ask yourself if you would invest into your own startup now. You know, look at it that way. I think that's super important to just flick the profiles, um, because I think founders just don't do it enough. They just have their own preferences in mind and they don't take into, you know, we're all human. They need to feel comfortable in investing. Are you actually ready or are you not? So I think the whole pitching too early is a big mistake because another thing is well, you're representing yourself and then what? You try to come back again at when you get more traction data. And some will open the door, some will say, sorry, we've seen you don't interest me enough, or you had a shot already. So we're not accepting second goes. So you just want to make sure the initial is you're prepared, essentially.
Okay. So if you pitch too early, then you can lose the trust in the beginning, and after you lose trust, it's going to be harder for your next second shot.
Exactly right. And then what it means is, you keep doing the same thing without less traction, and all of a sudden you've ruled out, you know, 60%, 70% of, let's say, investment firms in your region or location. And it's become a bit of a problem for your startup, right? To get funding. So I think, yeah, just having strong evidence, it's almost like going for a loan, just making sure that, you've prepared and you've got good history and good track record, I guess. Same sort of thing, right?
How can founders effectively prepare their teams and data for due diligence, and what common pitfalls should they avoid?
Yeah, so just having like a clear lineage. So just making sure that you have, what an investor profile wants to see. So traction data, that profit and loss if you post revenue, um, financial snapshot, so forecast, use of funds is super important. So what are you going to use with those funds? The milestones that you might hit with those funds, but also taking it back as well in more the early stage of your deck, for example, should be motives. What are your motives for starting this business? Because every good, I guess, seller, for example, that needs an investor will have a good story, or usually will be better off having a good story. So I think having some sort of motive behind why you started this startup is super important for investors, um, especially with the ones that have a personal interest in your business, right? For
Mm,
example, angel, family office, etc.
mm, mm. So in your opinion, um, how does personal story can increase your attraction of investors during the fundraising? For example, the same startup, but in a pitch deck, he decided to add personal story
Mm.
behind.
Yeah.
How much percentage it will, how do you think it increase in terms of attractions? Because you can definitely just make up a story, right?
Yeah.
If you know like a life hack.
Sure. And you probably see this time and time again, right? But the whole thing is really you're selling yourself as well as the business, right? So if someone has relatable experience or understanding of that individual, they're more prone to perhaps like them more. So realistically, your odds are higher in terms of,
Mm,
engagement and what that looks like is investment, right? So
mm.
another
And
thing as well is you want to also have just obviously social proof. So yeah, whether that's endorsements socially, partnerships, so forth, and then runway to profitability as well as metrics around burn rates, super important as well.
you said the common mistake is starting fundraising too early. So let's say I'm a startup. How do I how do I understand that it's time to start fundraising and it's not a time? What are criterias?
Yeah. Well, the criteria is really come down to, ask yourself why you can't bootstrap this anymore. Ask yourself, why, what's missing, and why am I looking, to hand off, for example, the general case is equity. Why do I want to give off equity for funding, for money, for cash? And you got to realize, well, why is that the case? I think it comes down to asking the question initially. But I think there's a few caveats around that, whether that's building stronger IP, it might be to do with, defensibility around brick and mortar, building out, like having to essentially build more infrastructure. Um, Sometimes people don't have that liquid cash to do that, so they need to external money, to leverage essentially. But the best founders will bootstrap as much as they can because they know their IP is perhaps super valuable and they don't want to give away as much equity, right? So yeah, I mean, if that kind of answers your question.
Okay. Um, and I think it's like last question. What's one piece of advice you'd give to a fintech founder who is just starting their fundraising journey? Who just realized that I need money, I need to scale, and I don't have enough cash for it. So,
Yeah, yeah. So I think really you want to be testing. You want to make sure the metrics, are in place. Just like margins, high margins, you're in a really competitive space as well, right? You want to have solidified partnerships, or you want to have test case. You want to run pilots, as many pilots as you can, and you want to get feedback, and you also want to have a good team behind you. So realistically, someone, in the finance industry, someone in the tech industry, and perhaps a coder or of the likes, maybe someone that has offshore presence that can scale you into emerging markets or new markets. Obviously, fintech, you look at the big players, obviously, US, realistically, founders that would do well would ship to the US, or at least have strong presence in the US. It goes for a lot of startups just because of, the moat, essentially. So,
mm, yeah, that's really great advice. Randor, this has been an incredible, insightful conversation. Thank you so much. Your expertise on navigating fintech funding landscape, from identifying like the red flags to understanding future trends, has been really like valuable. Thank you so much for joining us today.
thank you, Daniel. Yeah, appreciate it. No problem.
Thank you. Yeah.